The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I am Alex Steele.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. Things feel a little bit oddly quiet, like the calm before the storm.
Well, yeah, but is the job market going to really have the storm tomorrow? So we're seeing absolutely nothing happening within the market, guys. I hate to break it to you. The S&P did have a little dip down by about half an hour ago, and now we recouped, and we are pretty much unched on the day. The Mag 7 did have a nice rally underway. That has now lost some steam as we look forward to Amazon after the bell. That's flat. The VIX also very calm at 15. And then you have the Bloomberg Dollar Index, also very flat, despite Treasury Secretary Scott Bessent talking very positively about wanting that strong dollar. So, guys, there's nothing happening on an index level. That's all I got for you.
But another Mag 7 name reports exactly 1 minute after the closing bell. This time it is Amazon, expected to report 10% revenue growth, fueled by cloud computing, advertising, and of course, online sales. We'll also keep an eye on the consumer through the lens of travel, video games, and cosmetics when Expedia, Take-Two, Elf Beauty, and Affirm publish their results as soon as they hit the tape. But for now, caution prevails with stocks pretty much unchanged as investors await those earnings and the first jobs report under President Trump tomorrow. Now, the wrinkle with that jobs report is that the data will include an entire year's worth of revisions, though economists are expecting the markdowns to provide more relief than concern. In the meantime, Alex, you mentioned Trump's new Treasury Secretary, Scott Bessent. He is making the media rounds this week, clarifying that the president wants lower Treasury yields and not necessarily a Fed rate cut. Today, he told Bloomberg that Trump favors a strong dollar policy. Take a listen.
First of all, the strong dollar policy is completely intact with President Trump. And I was very happy at his Economic Club of New York speech in August when he reemphasized the importance of maintaining the dollar reserve currency status.
In that way, Bessent sounds like every other U.S. Treasury Secretary talking about that strong dollar policy.
Right. And can you have that stronger dollar and lower yields? Of course, that is the eternal question when it comes to the bond market. All right, Scarlett, you were talking about earnings. Let's take a broader view here. So this is using the EA function. It's really fun to play around with. This looks at sales growth and earnings growth. This is earnings growth, and this is average sales growth. Now, the orange line is for all industries that we've seen so far, and the gray line is for consumer discretionary, where the likes of Tesla and Amazon live. Now, you take a look at the current quarter that's reporting right now, and you can see average sales growth for consumer discretionary just not really catching up to the broader S&P, and same for earnings growth. Now, throughout the year, though, earnings growth actually in the sector for consumer discretionary could really support the overall sector, and that really comes down to the likes of Amazon, Scarlett, which is what makes Amazon's number so important since it's such a huge driver of earnings for that particular sector in the S&P.
All right, and Alex, of course, we will break those numbers for you as soon as they cross after 4 p.m. For this hour, let's kick things off with Savita Subramanian. Savita is head of U.S. equity and quantitative strategy with BofA Securities. Savita, it's great to see you. I want to get your take on earnings so far. Aside from the numbers, and of course it's a game, right? Because the executives make sure that the numbers are low enough that they can beat them, and then they get a positive reception in the markets. I'm trying to get a sense of what you've learned from the company executives, especially when it relates to policy uncertainty and how they're navigating through that. What's the biggest takeaway for you?
Yeah, I think the biggest takeaway that we're seeing in the numbers and the stats is that guidance is actually tracking a little bit weaker than where it's been over the last few years. So management is actually guiding down more aggressively than above consensus expectations. This isn't anything cataclysmic. In fact, it's very typical early in the year. But for the last few years, I think where we were was an environment where companies were actually guiding above more aggressively. And now perhaps this is just a sign that analyst expectations are back to normal. They're not depressed, coming out of COVID or coming out of the rate hike cycle of 2022. So here we are. Guidance is tracking the normal seasonal low levels. Earnings beats, as you point out, are very healthy. We're tracking a pretty healthy, I think, a 5% beat for the S&P 500 from companies that have reported so far. Financials are leading the beat. Commentary has been relatively positive. What's surprising to us is that when you sort of put all of the transcripts into our NLP or natural language processing sausage grinder, it spits out that corporate optimism is at all-time highs, which is unusual, I know, not necessarily what one would expect, but I do think that from a numbers basis, what we're seeing is more cautious guidance, maybe even more cautious than one would normally be given the policy uncertainty out there.
That's super interesting, the contrast between what the numbers are showing and what the commentary sounds like. I mean, ultimately, ultimately nobody knows what's going to happen, including the president himself. Given the full spectrum of possibilities out there, do you think there perhaps is too much focus on tariffs at the expense of immigration and, the effects on the labor market in certain industries?
Yeah, absolutely. I think the tariffs are really capturing mind share. And obviously, it's a much more kind of dramatic scenario. And we've heard a lot of news and lots of changes to policy in the last week or two. Look, I think that there is also, the bullish side of things, which is potential for deregulation. And then immigration reform, which would be negative from a margin perspective, higher labor costs, but it could be positive for real wage growth for, for the average worker in the U.S. So I think there are puts and takes on everything. I think what we haven't really focused on also is just the change in the mix of the S&P since 2018. So tariffs, while the numbers sound very high, what the good news is that companies have already been, kind of experiencing this learning curve of how to deal with tariffs in China. They've managed to move a lot of activity out of China closer to home. Unfortunately, a lot of that activity was shifted to Mexico and Canada, which are also in the crosshairs today. But I think the idea that we're going to see this massive swoon in earnings from tariffs isn't necessarily part of the story. And even the inflationary impact might not be as aggressive.
Yeah, and also you brought up the positive parts, right, which means sequencing is also important. So how's sentiment, Savita?
Sentiment has caught up with this bull market. So, unfortunately, it's not one of those scenarios where you can say this market is so hated, you still want to buy it. We're at a point where our sell side indicator is almost at a sell signal. So what that means is the sell side has grown that much more positive. They're recommending much higher allocations to stocks. That said, they're only, the average sell-side strategist's recommendation to equities is just around 57%, which isn't super high relative to, the benchmark allocations that we've seen of 60% equities. So, it's been higher in prior cycles. During the tech bubble, there were, strategists were recommending a 70% allocation. So today's numbers are definitely higher than where they've been over the last few years, but they're not necessarily at super stretch levels. And where I think the real optimism across Wall Street is on these Magnificent Seven companies. If you look at growth expectations for the Magnificent Seven analysts, the consensus analyst is forecasting the strongest growth ever for these 7 companies, which is hard to really see happening given that they're bigger, they're not going to grow as fast, and they're also spending a lot more on CapEx. So I think that's where we're seeing absolute euphoria.
So then based on that, where's your pain trade?
I think the pain trade is really what we've seen so far, which is, kind of financials outperforming. We're seeing some value areas outperform. January was an interesting month because the only sector that was down was tech. Every other sector was in the black. And you had large cap value outperform all the other size and style segments. So I think that's where we want to focus, is just potentially a change in style, not necessarily buy all the small caps, but maybe get a little bit more valuation sensitive and, kind of look at expectations for these tech companies versus what they're actually going to achieve.
All right, good stuff. Savita, always appreciate your joining us here on The Close. Savita Subramanian, head of U.S. equity and quantitative strategy over at BofA Securities. We've got a lot coming up on The Close. President Trump is scheduled to meet the CEO of U.S. Steel today. Could that possibly resurrect that block deal with Nippon Steel now that a new president is in the White House?
Plus, a conversation about real estate with Lauren Hochfelder, co-CEO of Morgan Stanley Real Estate Investing, why she sees a bottom forming in private real estate.
And from real estate to a mortgage and commercial lender, a sit-down with Steve Steinour, chairman, president, and CEO of Huntington Backshares on the heels of the company's Investor Day. This is The Close on Bloomberg. time now for our top calls, a look at some of the big movers on the back of analyst recommendations. And let's start with Reddit. Seaport Global starting coverage of the social media company with a neutral rating and no price target. The analyst says he is positive on Reddit's long-term fundamentals and views it as an attractive platform for advertisers, but says the stock's valuation is what's keeping him from a buy rating. Shares currently down about 3%.
All right, Scarlett, I'm taking a look at Skyworks Solutions, with supplies chips for use in mobile devices like Apple's iPhone. Skyworks warned about content losses in the upcoming quarters, prompting multiple downgrades, including one from Stifel. The analyst described the loss as a, quote, new and unexpected headwind that fundamentally reverses our 12 to 18-month growth thesis. Yikes, the shares are off by 24%.
And finally, CarMax, the used car retailer, upgraded to outperform from inline at Evercore ISI. The analyst says if Trump's proposed tariffs go into effect, it could accelerate a consumer shift to used vehicles. He also expects a solid growth forecast from CarMax when it reports quarterly results on Monday. The share's up almost 3%. And those are some of our top calls. Now, President Trump is also meeting with executives from U.S. Steel later today as questions swirl about the fate of the company and the takeover bid from Japan's Nippon Steel. This comes just one day before Trump is due to meet with Japan's Prime Minister Ishida. Joining us now for more on this development is Timna, Managing Director and Equity Research Analyst over at Wolfe Research. Timna has an outperform rating on U.S. Steel. Timna, do you think this meeting between President Trump and U.S. Steel CEO Dave Burritt will result in any change on that deal to consolidate Nippon Steel and U.S. Steel?
Hey, I think that you've got to believe that if they're meeting, that something could be brewing. So I think that the odds of a possible Nippon takeover went up a little bit. And it does, doesn't jibe with the past, which is that Trump was adamant that he was not going to approve the deal. He said so quite vigorously several times during the campaign. But since he's been elected, he did not follow through yet, at least, with squashing the deal. So there is, I think, still a little hope, obviously still meeting with the Prime Minister of Japan tomorrow that could prove some positive move. But at the end of the day, we still believe it's probably a standalone entity after these meetings.
Interesting. I guess also the other thing is that Nippon Steel reported earnings overnight, and they were talking about President Trump playing a role here, saying that if he understands this appeal from Japan correctly, he will support this matter, which makes it feel like the Prime Minister of Japan is going to make a more pointed argument here for this deal to go through.
Yeah, a lot rests on these meetings. I thought the Nippon Steel communication was very candid. It just said, we can't guarantee that anything will happen, but a lot rests on what the politics decide, which, as you know, is unusual, but this has been an unusual deal since the beginning, very politicized.
Hey, Timna, you've been an ardent supporter of U.S. Steel in that you think it can go it alone without the Nippon Steel deal. You still believe that?
Absolutely. In fact, in our recent publication, we pointed out that as of the 2025 forecasts that we have with consistent steel prices across the board, U.S. Steel is best positioned of our coverage to have the highest free cash flow yield.
Then what happens if we get tariffs from Mexico and Canadian imports and even Chinese imports on metals like steel and aluminum? Is that like a good thing for U.S. Steel or a bad thing? Like, how do you put that into a model?
Sure. So broadly speaking, the U.S. steel industry should benefit from tariffs, right? Canada and Mexico, especially Canada, brings steel into the U.S. They're one of the largest importers of steel. Mexico, not so obvious, but if you have, less imports, that helps the price go up, and U.S. Steel is particularly well positioned, we would say, to benefit there.
What are your thoughts here on Ankara, the activist investor here, which has nominated 9 candidates for U.S. Steel's board, and trying to be much more influential in this company? Is there anything to this? Is there anything more to this?
We don't see any teeth as it stands. It's kind of unusual to see a company with 0.18% holdings, as we last saw at least, to try to make an influence on the company. We don't think the recommendations broadly to have different management or focus on their operations are bad recommendations. I don't think it makes sense for the company to abandon the Nippon bid because it would be positive for shareholders if it could go through. But at the end of the day, it is kind of unusual that activists come in and the shares don't go up. So I think it puts a floor under the stock, perhaps, but we don't see anything to it for now.
Does that maybe scare off other potential activist investors from coming in?
I don't think so. I think an activist investor that really had, shares in the company perhaps could have more of an influence. If you had a different management team, I don't think that would be a bad thing. But at the end of the day, I don't think U.S. Steel, needs a lot of changes. I think it can go it alone. I think its strategy of, looking to have both blast furnace, electric arc furnace operations and investing in their new electric arc furnaces, I think are good strategies.
Hey, Timna, you've been covering this industry for a really long time. What's your favorite pick right now in the midst of all this uncertainty?
Yeah, U.S. Steel is our top pick. We think you have a combination of benefit from some of the recent price hikes that we think can stick for the near term, and also the benefit of new capacity ramping up, and a sliver of a chance still that the Nippon deal goes through. So U.S. Steel is our top pick. We also are a bit cautious into the second half of the year because of quite a bit of new steel capacity coming on. But, U.S. Steel is one of them adding capacity, so they're still best positioned, we think, in light of that concern we have.
All right, Timna, really appreciate that. The stock is up over 20% so far just in the last month and a half or so. Timna Tanners over at Wolfe Research, always great to get your perspective. All right, coming up, we're going to speak to Macquarie Asset Management's Ben Way about their investment strategy, where they all see opportunity in the current market, from real estate to credit and to equities. This is The Close on Bloomberg. Markets moving absolutely nowhere. We get the jobs data tomorrow at 8:30, looking for about 0.9% move in the options market, according to Piper Sandler. So I want to broaden out and take a look at how you manage all the difficulty and risk. Macquarie Asset Management's outlook for 2025 report is out, saying that we have transitioned to a new normal, where neutral rates are likely to remain elevated relative to the past decade. And the key risk to their outlook for the year is more stubborn inflation, particularly if we see an escalation in trade conflicts between countries. Joining us now is Ben Way, Group Head at Macquarie Asset Management. There's a lot to unpack with that, because a new normal where rates aren't so low very much is difficult when it comes to it's in contrast to then strong growth in the U.S. exceptionalism trade. What's your biggest call?
Look, our biggest call is the fact that, there's huge opportunities still in the private market sector right around the world, being driven by, the big global thematics, whether it's digitalization, decarbonisation, or deglobalisation. So, we think within the private market sector, whether it's real estate or infrastructure, there are huge opportunities to go out and create capacity to meet unmet needs, and those remain very strong. If you look at something like the US here, if you look at self-storage, if you look at manufactured housing, if you look at logistics, those are all deep opportunities that require more investment and more capacity to, if you like, respond to and put in the building blocks for the economies as they continue to evolve. So, we're excited about that. We think global growth has been very resilient. We've seen today central banks in certain markets starting to reduce rates, which we think will really help markets bounce back and give markets more confidence. But we think those big thematics really underline the key thematics and the key investment opportunities.
Well, what if central banks can't lower it as much as everybody thinks because of policy and tariffs, et cetera? Does that disrupt your love of real assets and infrastructure?
I think no, because in a high or low interest rate world, generally the infrastructure, for example, has delivered very good returns. And you often have some sort of inflation hedge built into infrastructure assets anyway. I think what we do need to be prepared for is, many of us have been forecasting how many rate cuts there would be last year, how many rate cuts there will be this year. Do we really know? I think the answer is probably not. What we do know is that there's going to be ongoing volatility. And, volatility is not necessarily a bad thing. Obviously, for the public side of investing, that creates opportunities all the time. But that volatility, I think, is more a manifestation of that we are transitioning from a post sort of World War II Pax Americana world to a newer international arrangement. And so, things that we've got used to investing in the last 70 years may pivot, but that creates opportunities. It creates opportunities in terms of deglobalization and the need for more capacity around onshoring and nearshoring. So just as opportunities move away from private markets, new opportunities arise. And if you think about data centers, right? No one was really investing in data centers 10 years in a material way. No one was really doing it in the material way we see it today 5 years ago. But because of the digitalization, the move to cloud, and now the the injection we've got from AI, that has become a much more focused sector with great returns for investors.
How far along the process are we in that build out of data centers? I mean, are we, to use a baseball analogy, in the second inning or are we in the eighth inning?
I think we're in the second inning. It has a long way to go. I mean, often we talk about data centers and they're going to use all the world's electricity, but they actually only account for 2% of the world's electricity consumption today. We all know that AI has a long, long way to go. We're really just at the beginning of what this means in terms of investment opportunities, applications to the world. Just as the digitalization of the world and the move to cloud and the move to an app economy has really only taken place from a convergent point of view over the last 20 years. And that has a long way to go, just as data centers do. So, we're excited about that opportunity, and you can see that right around the world, there is not enough hyperscale capacity today. There's a huge demand from all the big tech companies, and even allowing for perhaps some moderation in terms of AI demand, that still has a long way to go.
I like how we went from physical infrastructure to digital infrastructure. And when you look at data centers, is it through publicly traded companies, REITs, for instance, or is it through private companies?
Well, the way we're making our investments is really through private companies. There's an array of investment opportunities out there for both wealth and institutional investors. But what we've done is built, a digital infrastructure base of, some sort of, 30 companies over the last 25 years. That's about $60 billion of assets, and that's primarily done by really spotting great management teams that have identified the right powered land, have the right relation with customers, and then really bringing capital and expertise to scale them up. And we've done that here in the US with Aligned. We did that with AirTrunk that we exited at the end of last year, which is the largest ever exit from a data center business globally. But there is an opportunity for investors to continue to find those opportunities. But of course, like everything, it's about finding the best management teams with the best client bases.
30 seconds, real estate. You like it?
I think
we bottomed. It's going to get better?
I think it will get way better.
Okay.
Not all parts of real estate, but I do think where you're creating capacity to meet things like unmet needs, particularly around build to rent, self-storage, those sorts of things, I think those are great opportunities and a long way to go.
All right, Ben Way, really appreciate your joining us.
Pleasure.
Ben Way is group head at Macquarie Asset Management. Now, coming up, we'll check in on the real estate market with Lauren Hochfelder. She is co-CEO of Morgan Stanley Real Estate Investing. They're talking about 2025 being a good vintage for private real estate.
That means that they're going to do really well, right? Is that how that works? Okay.
We'll ask Lauren.
That the bottom has already been in, and
There
it's
you
only
go.
going to get better. We'll break down kind of where to look for that.
This is The Close on Bloomberg. It is just about 3:30 p.m. in New York. This is the countdown to the close. I'm Scarlett Fu.
And I'm Alex Steele. So you're definitely looking at equity market going nowhere fast. You are seeing a touch of selling, though, in the bond market across the board. The real question is, how did the Trump administration lower those long-term yields? They're giving up the short term. They're like, the Fed's going to do what the Fed's going to do, but the long end is now the question mark.
We're going to jawbone it. We're going to jawbone it lower.
Or is it the deficit? And then how does that work if you have a higher dollar as well? That, of course, the question among economists everywhere. And how low rates go have a direct impact on housing and on real estate. Well, one analyst says that America's biggest office leases are expected to get a whole lot bigger this year. That's as more companies actually call their employees back to the office for in-person work. Here with more on her outlook for this year is Lauren Hochfelder, co-CEO of Morgan Stanley Real Estate Investing and head of MSREI. That was hard. Americas. Thank you for joining us.
Thank you.
So give me your pitch. What do you think is going to happen for real estate in 2025? Best call.
Look, I think 2025, 2026 will be a fabulous vintage for private real estate. It's our job is to generate returns through cycles regardless, but the best performance comes in periods of recovery. And 2024 was moderation, starting to see a bottom forming, liquidity coming back, transactions coming back, cost of capital down. 2025, 2026, we think will be the transition into an upcycle.
I just want to stop you for a moment. You've said vintage. What do people mean when they say 2025 will be a good vintage? I know it's a private equity term, but does it signal anything about whether it's a good time to buy real estate, or is it a good time to sell if you have been holding it?
It's a great question. So It's generally referred to as a period to buy it in. But the reality is, as we're seeing liquidity back, I would say we are selling certain assets that we've acquired over the last couple of years into that strength.
So to that point, if yields don't go materially lower, and let's say they stay around here, does that change or disrupt your call?
Not really. The reality is that, look, we do expect they'll moderate in some, bumpy slope down, but we don't expect rates to get back to pre-COVID lows. And that means that unlike the period post the GFC, where real estate really appreciated with, low rates and cheap debt and cap rate compression, this time around, we think it's really about cash flow growth. And so that means you need to be in those sectors and markets that are really propelled by long-term mega trends, more durable drivers of demand. And it also means you need to work your assets really hard. We are very hands-on in trying to not just buy and hold, but buy and change.
So of those megatrends, I'm really intrigued by aging demographics. What does that look like for a market like the US versus in Asia or Europe?
Yeah. So what's interesting is we're seeing aging demographics in most global markets. I'd say in the US in particular, when you look at the baby boomer cohort, it is a very large age cohort and it is wealthy. And so as they're aging, right, we can sit around and speculate what's going to happen with rates. We can calculate the silver tsunami, right? We know the number of 80-year-olds that's coming. And with that, the changes in their housing needs. So we've been very active, for example, in senior housing. So that's a space where we can see the real demand runway with this cohort. And beyond that, supply is way down. So the combination of the supply demand, and then frankly, it's been dislocated temporarily from COVID and coming out of that. So there's a really attractive entry price as well.
We talked about in the beginning, talking about office real estate, for example, people coming back to the office. What's your call on office real estate? I always hear that, the tier A assets are amazing, but no one ever tells me they like the B and the C properties. Are you going to tell me that?
Unfortunately, there's a reason. No, but what I will say is people talk about sort of, the best and the rest or what have you. What we're seeing isn't just a bifurcation. We're actually seeing those A-plus assets become almost an oasis in the office desert, because you're seeing such a consolidation of demand into the best of the best. Tenants are taking less space, but paying higher rent. And so San Francisco is almost 40% vacant, but we are getting all-time high rents in some of our assets.
Right.
There.
It's just the B and the C's that are sitting there empty. Absolutely. How do you go about repurposing that? What is the movement on repurposing some of that property?
Yeah. Well, fortunately, we don't have much of that, so we're not going to be repurposing it. But look, there are alternative uses. People talk a lot about residential conversion. That works really well for certain floor plates, certain window lines, certain, sort of mechanical systems, et cetera. It doesn't work very well for other uses. So I think we're going to need to be creative. I suspect there'll be some private-public partnership as some of these cities really address this glut of supply.
Globally, where's the best opportunity right now?
So we're most active here in the US and in Japan. Obviously for very different reasons, but
both aging demographics.
That is true.
Yeah,
that is true. And what's interesting actually about Japan, so we've been investing there for 25 years. And obviously there's been no growth and the demographics have been really challenging. But it's been a fantastic opportunity for us. Obviously you have a great spread investing opportunity, but we're also seeing this time around, for the first time, the positive effects of healthy inflation flow through to wage growth, flow through to residential rent growth. And on top of that, all the focus on corporate governance reform is creating opportunities to buy assets from Japanese corporates that are trying to rationalize their balance sheets. So that's Japan. The U.S., look, U.S. to me is FIFO, first in, first out. It corrects the sharpest, it rebounds the quickest, and we see that in past cycles. We're seeing that again now.
I got to ask you about the last megatrend, which is supply chain changes. And it feels like we can't avoid it given the news flow these days. There's a lot of political uncertainty. It's certainly in flux. But is this the obvious stuff like nearshoring, automation, or is this something more nuanced?
So it is certainly more nuanced. But it's so nearshoring, onshoring, friendshoring, they're big, they're big terms, but under the surface, there's so much going on. So you look at some of the onshoring markets here in the US, in the Midwest, in the Southeast, there's so much under the surface in terms of where government incentives are going or which industries are driving which markets.
All right. Nuance, it sounds like, is the key to the game here. Lauren Hochfelder of MSREI, thank you so much for joining us today.
Thank you so much.
Really appreciate it. We've been speaking about real estate. Well, speaking of real estate and rates, U.S. Treasury Secretary Scott Bessent sitting down for a live conversation with Bloomberg's Saleha Mohsin, in which he says he met with Fed Chair Jay Powell and trusts him to make the right decisions on monetary policy.
I want to ask you if you have had your traditional weekly meeting with Fed Chair Powell yet.
We did. I did an away game over at the Fed. We had a very nice breakfast. Chair Powell and I don't know each other well, so it was very constructive.
How do you view that relationship evolving? The two agencies and buildings are supposed to work very closely together, and you've had some criticism in the past of his work.
And as I said at my hearing, everything I'm going to talk about is things the Fed's done in the past. Prospectively, monetary policy, I will not comment on, and I'm sure he's going to do the right thing, so there'll be no criticism.
Joining us now to discuss the prospects for his bank is Steve Steinour, Chairman, President, and CEO of Huntington Bancshares. Steve, great to see you here in person.
And thank you so much. Great to be here.
What kind of assumptions are you making when it comes to interest rates, given that you just gave your presentation on Investor Day down the road? What are you thinking? What are you seeing?
Well, we think rates are going to hover about where they are. They could be down or up a little bit. It won't have a material impact on our economic activity or the economic activity we lend into. So we have a very strong forecast for continued growth. We had a great year last year, peer leading, number one, and we expect to do that again this year.
All right, you talk about continued growth. I know at the Investor Day you spoke a lot about your brand nationally, and it's something that analysts have noticed you haven't really done before. What's the distinction here? What's the value proposition of Huntington Bancshares?
Well, we have a number of different components to the proposition. We have a powerhouse consumer and regional bank in the Midwest. We're very, very large in Ohio and Michigan in particular, but we're in multiple states. We've announced that we're moving into North and South Carolina with 55 branches over the next few years, so we will take the entire franchise to that state. In addition, we launched 8 verticals over the course of the last 14 months. These are national businesses, and they're on top of 8 other national verticals in our commercial bank. We also launched into Texas. So we need a national brand emerging in order to open up these business lines even further.
Does that put you in competition with like JP Morgan or Bank of America or Citi or something?
Yes, it does. We're in competition with them. We've been in competition for years. JP Morgan has a heritage in Columbus, Ohio, where we're headquartered, as the old Bank One, for example. We compete every day. We have for many, many years. And
so you're comfortable competing with them now?
We are.
Not a big deal.
We are.
Okay, then does that all, as you expand like this, does that mean more M&A?
Not necessarily. In fact, our focus is on organic growth. And so we've done 2 depository institutions in the 15 years I've been CEO. So, this is not an essential element of our growth. We drive the core at organic growth, and as we've done before, we're one of the few regional banks that is growing both the consumer and small business. We call it regional banking, consistently year in, year out, at 2% and 4% respectively for primary households.
What are the benefits of growing organically as opposed to buying some of that presence that you want to build out?
Well, purchasing or M&A also has risks. It's detractive. It takes a lot of effort. It's disruptive to the acquired customer base. There are a lot of elements that go into making a successful integration. At this, for us, growing the core where we've already invested, we have foundational investments in these vertical groups, in these regions. We need to leverage them up now. They are great growth vehicles for us for the foreseeable future. So the revenue will just incrementally expand, and expenses are largely, essentially flat. It's a great sort of gap that's widening for us.
Yeah, I ask because a lot of analysts point out that Huntington has a good valuation to do a deal. So it would make sense to do something as opposed to not take advantage of that.
Well, it's not just valuation. We've earned the valuation because we've driven the core. We've made a lot of investments in driving that core, these new regions, Texas, North, South Carolina, the 8 verticals, et cetera. We need to realize the economics off those investments, which we think we have years of runway in front of us. And we will do other things as well.
Talk about your regional part, less your consumer part, but when you're working with small businesses, optimism is so high.
It is.
What are you hearing? Well, what are the words on the ground? Do you hear anything about tariffs? Like, what's the scuttle?
Well, there's been a lot of volatility the last 3 weeks around tariffs. To some extent, the response is we've seen some of this before. It'll settle down. We're confident it will settle down. And, we'll get on with it. Businesses will get on with it. For small businesses, there aren't that many that are impacted by tariffs. These would generally be mid-corp or large corp. So not a particular issue. The focus is more on interest rates and where will they be going.
So how sensitive do you think then those small businesses are to interest rates? Like if we stay here or have one more cut, does that really change the game?
Not at all. I don't think it's meaningful. There's a lot of confidence in President Trump, in the administration, in the willingness to go forward, dynamically growing the economy, and we see that constantly from our customer base.
I want to get your thoughts on regulation. You mentioned Trump. We have new regulators, of course, and they're seen as more light touch, right? They're certainly not driving the bus the way that they were in the last administration. How are you thinking about the limitations that they place on the industry? The Fed, for instance, just ended its program that required the biggest banks, the 6 biggest banks, to submit data for a climate stress test, for instance. I know that that doesn't affect Huntington Bank, but down the road, these are things that will be less costly for banks overall.
Well, I think the regulators, and remember, the appointments haven't even been made yet. So I think over time, we will see a more constructive, supportive regulatory environment, not just for the banks. Remember, the banks drive the economy. We're the conduit. We're where merchant activity flows through largely, and particularly the regional banks. We do most of the small business lending in the country. So that will be very beneficial, I think, to the economy and our society as a whole. That's where job formation occurs.
Has the regional banking industry completely recovered from Silicon Valley Bank, from First Republic, from all the turmoil from a couple years back?
I think largely they have. Now, for us, we saw that as an opportunity. We had best-in-class liquidity. Our liquidity was better than any bank, $50 billion or more. That includes the largest banks. Our capital was strong, our credit was great, top quartile performance, and our earnings were consistent. So that's when we chose to invest, when others were maybe concerned or had to pull back.
That was your opportunity.
That's right. We didn't have too much commercial real estate or anything else. That was our opportunity. That was our window. We took a contrarian play. It's working very, very well for us.
Before we let you go, you also talked about the opportunity in payments.
Yes.
What are you going to do to differentiate yourself from like Block or Stripe, for example?
Well, we have a lot of different products. And so we've got hundreds and hundreds of thousands of business customers, and we make loans to them. We handle their treasury management, perhaps their risk management, foreign exchange, derivatives, or other things. So we put that all together now in terms of a merchant offering that's in-house, and we can bundle it, things that we didn't have the ability to do because we had outsourced that. So we changed that. When you talk about Stripe and some others, that's where we're in that payment flow. We've got a great partner there, Fiserv, that does the back end, and they put us in a very competitive position with their capabilities.
Oh, so you're not a competitor of theirs. You work together in some ways, like you use their stuff.
With Fiserv, but not Stripe, yes.
Okay, great. Hey, Steve, thanks a lot. Really appreciate it. The stock was up today as well, so thank you so much for stopping by. I know it's been a busy day for you, Steve Steinour, Chairman, President, and CEO of Huntington Bancshares. All right, coming up, we're 15 minutes away from the closing bell. We're going to take you through that with Amanda Agati, Chief Investment Officer with PNC Asset Management Group. I'm not going to lie, market's doing nothing, but we do get Amazon after the bell, 4:01. Stay tuned for that. This is The Close on Bloomberg.
I think the biggest takeaway that we're seeing in the numbers and the stats is the guidance is actually tracking a little bit weaker than where it's been over the last few years. So management is actually guiding down more aggressively than above consensus expectations.
That was Savita Subramanian, head of U.S. equity and quantitative strategy at BofA Securities, kicking off the show, talking about how guidance is tracking lower, some nervousness in the market, even with the recent gains that we've seen. I mean, we are still up for the year.
Yes, but we're losing steam here today. I mean, the S&P is up 0.2%. We had a little dip at around 2, and then we rebounded from that, but it feels like not a lot of conviction right now. The Mag 7 now able to get into positive territory. We also have the consumer staples index up by about 0.7% as well. And then you have the Russell a little bit weaker. But, from the moves we've seen this week, this feels like a very calm, idiosyncratic day. I just wonder what happens in 10 minutes' time after we get Amazon.
Although you mentioned consumer staples, they're the best performing group so far in February, up about 7.5%. It feels like investors definitely continuing that rotation away from big tech to some of the defensive sectors.
That's a great point. And also sort of then how much risk do you take on versus where is the safety trade? And like yesterday, for example, it was real estate, it was utility, it was the traditional like lower yields, go for those safety trades that were doing really well.
All right, for more market analysis, let's welcome Amanda Agati. She is Chief Investment Officer. And of course, we want to bring her in now. Amanda joining us from her location. Amanda, let's talk a little bit about this idea that investors are rotating away from big tech to some of those more defensive sectors. You heard Savita earlier talking about guidance perhaps tracking a little bit weaker than what we normally see at the start of the year. And seasonally, guidance does tend to track a little bit weaker. Is there something more under the surface that we're not taking quite into account?
Well, it's great to be with both of you, and it's a perfect question to start on. I think really this is a little bit more of the natural evolution of the innovation cycle we're seeing for the biggest AI leading companies. They've just been on a tear these last few years. And so is it natural to start to see some of the guidance slow down just a little bit, that rate of change or that trajectory slow? Yes, I think it's reasonable. I don't think that it's a cause for concern. The challenge is when you have a market that's priced to near perfection from a valuation multiple perspective, it just doesn't leave a lot of headroom. So even though results have come in pretty solid, I would say, maybe a little bit weaker on the guidance front, but pretty solid overall, it's been a punishing backdrop for some that haven't quite met that high bar for expectation. So I think investors are naturally starting to think about, is there life, is there growth in other parts of the market, which is healthy in terms of the rotation. It
is healthy, but it speaks to how extended maybe some of the optimism is. According to JP Morgan, retail investor sentiment is at a record high, topping even the 2021 meme stock mania excitement. And according to Barclays, individual investor exposure to stocks are near the high since 1997. So people are very long this market right now.
Absolutely. And I mean, why not? We've been on a tear here for these last couple of years. And when you look at the underlying fundamentals, that is earnings growth for the S&P 500 still looks really strong for this year in the neighborhood of 13 to 15% year over year growth. That's really solid. And so that speaks volumes about the potential for the market continuing to rally forward here in 2025. And we're not talking about recession. We're not talking about a hard landing or even a soft landing. So I think it certainly aligns with sentiment being positive. I think the challenge for investors navigating this market is a lot of fiscal policy uncertainty this year that we haven't had in the last couple of years. And so that's going to create some fits and starts. And I think, again, catalyzes a bit of rotation. You want to be long this market for sure, but I think you want to pick your spots carefully.
Okay, so where do you pick them? Just speaking also that Amazon is reporting, and then we have most of the Mag 7 in, and that was a really rocky road for some of those guys. Where do you rotate to?
Well, I think quality is the name of the game in this environment. I mean, we are not short the Mag 7. We're still very much believers in the AI story longer term. But as I said, I think there's a few headwinds as it relates to valuation in the short run. So we still believe quality is very well positioned in this environment, has not participated to the same degree as the top 7 or 10 names have. So there are pockets of valuation opportunity, relative value here in this market. And you have to lean into a little bit more of a cyclical story as well, particularly if the economic backdrop holds up. And even in the back half of the year, if we start to get a little bit of a mid-cycle reacceleration, those cyclicals are going to be very well positioned.
So does that mean you need to get out of, say, the AI trades, those hyperscalers, the Mag 7, and into the more cyclical trades, or you can kind of just have both?
I think you can have the best of both worlds. And I don't mean to sort of punt on your question, but I think what matters most in this environment is a little bit of risk management. That may sound bearish. I don't mean it to be bearish at all, but I think considering how much exposure you actually have in portfolios to the Mag 7, even the top 10 names, or just AI across the entire supply chain. Coming into this year, I think it's very healthy for investors to think about risk management, some level of rebalancing, and don't put that money in cash, right? Put it into some of these more value-oriented and cyclical parts of the market.
Amanda, what are you hearing when you are listening to the earnings calls or you're reading some of the transcripts and just getting the broad brushstrokes from corporate management? Is it really all about tariffs and inflation, or are there other underlying stories that you can really latch onto?
Well, I think the biggest one at the moment is, are we going to get tariffs or not? And are they going to be narrow and surgical, or are they going to be more broad and sweeping? And so what is the follow through effect? It's not so much the tariff implementation itself. It's what does it mean for inflation? What does it mean for Fed policy? And so there's a very much a trickle down effect or an interconnectedness to all of these things. But I think the theme that's coming out of earnings season is much more uncertainty across the board. It's not one specific policy. And that's what's made it, I think, really hard for investors to start out this new year, gauging what the path forward looks like, because there's such a wide spectrum of outcomes depending on what policies ultimately take hold this year.
Absolutely. So how much can you really trust what the outlooks are from this management, not just this management, but any of the management teams? Is it just, trust in that particular management team? Because they're giving you different scenarios, but they also have no idea what's going to happen.
Yeah, I think I want to believe, of course, as an investor, I want to believe in the guidance, but I think we have to be very careful about each data point and take it very seriously in terms of the trends going forward and course correct as more information comes into the equation, because as we've seen just in the last week or two, a lot of different angles coming in here from a policy perspective that can really change things on a dime. So I think investors just need to be very nimble in this environment, pay close attention to every data point, because it's really going to matter this year.
Yep, and we get the data point tomorrow with jobs coming at 8:30 and Amazon in a few minutes' time. Amanda, thanks a lot. Amanda Agati, Chief Investment Officer with PNC Asset Management Group. Taking a look into the market, we are rallying into the close here. We're now up 0.3%. I appreciate the 0.3 isn't huge, but we're significantly now off the lows of the session. We have Amazon earnings coming up. We have full coverage right here.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Alex Steele alongside Scarlett Fu. We're going to take you through the closing bell through a global simulcast. We're now joined by Carol Masser and Tim Steinour. Romain Bostic is off today. We're going to bring together our Bloomberg Television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the day, rallying into the close, guys.
Yeah, right. Just some buying. You're seeing an uptick, and we're pretty much looks like we're going to close at our highs of this session. Having said that, not real big moves, but we'll see what Amazon does after the close in terms of affecting market sentiment.
Hey, how about tomorrow's payrolls report? That's kind of the next catalyst I think people are looking for. The revisions for last month as well, obviously going to be very important. But we're kind of rounding out, getting past the Mag 7 when it comes to earnings. All we have after today is NVIDIA.
Yeah, but NVIDIA is now for another 3 weeks, so we'll have to entertain ourselves with retail
what are we going to
earnings. We're going to really fixate on the jobs report. Is it going to be the non-farm payrolls, the unemployment rate, or the average hourly earnings that people are going to obsess over and react to? It's kind of up for debate.
What's also interesting is you read some notes from JP Morgan's trading arm as well as Scott Rebner over at Goldman Sachs, and they both point out that the retail army is alive and well, like mom and pop investors coming in and buying all the dips, like 2 to 3% decline, and they are in there. And then you get corporate buying, and you have some kind of support here for the market.
Yeah, we just talked about that with our market guest, too, saying the same thing, that is certainly a positive sign. And, there's a fair amount of earnings that have been supportive as well.
But does it also say something about where we are in the cycle if the retail army is feeling confident?
I don't know. That feels like investment psychology.
What happened last time after
like getting tips from the taxi driver or the shoe shine boy?
Exactly.
I don't know about that, guys. All right, here we go. We're closing out this Thursday, moments away from Amazon. We're still settling out here, but it looks like the S&P is up by about 0.3%, a kind of a straight shoot higher here in the last hour of trading. The NASDAQ outperforming, up by 0.5%. Dow Jones, guys, a little softer. down by 0.3.
All right, taking a quick look at the S&P 500, almost an even split here. You've got about 259 names to the upside, Scarlett, 243 to the downside.
All right, let's take a look at the IMAP. A lot of green on the screen there, led by consumer staples, which are the best performers of the month as well. That group up 0.9%. Financials also gaining ground, about 0.8%. Tech in the green here by 0.6%. The laggards of the day, energy, healthcare, and utilities.
All right, guys, to some of the individual gainers. Ralph Lauren up almost 10% in today's session, hitting a record, reporting fiscal third quarter results that broadly top Wall Street expectations. They boosted their annual forecast for revenue growth and margin expansion. Off to another in the retail group, Tapestry up about 12%. It was the top gainer in the S&P 500, jumping the most since April of 2020. It raised its guidance again for the year on stronger than expected sales of its biggest brand. Coach, we've got Amazon out, guys.
All right.
Yeah, go. You go.
Oh, no. Go ahead. Amazon.
Okay, Amazon. Fourth quarter earnings for North America. Net sales coming in at about $115.56 billion. That looks like that was definitely a beat. Taking a look at AWS, that's the juicy Amazon Web Service. If you back out FX, that's up by 19%, bang in line with estimates. Operating margin coming in, and you have earnings coming in also higher, about 1.68. And first quarter net sales coming in about $155.5 billion on the high end. Caroline Hyde is joining us, co-anchor for Bloomberg Technology. There are a lot of numbers to go through. Can we just parse through a little bit here?
The forecast is going to be the unnerving part, right? The fact that they're saying the fiscal first quarter net sales will be 151 to 155, and the market wanted 158. So if we're going to say any fly in the ointment, it is the forecast. But the anxiety levels about AWS growth are going to be dialed down a little bit when you're actually looking at their numbers. We're seeing that they are managing to still bring in that 19% growth if you extract some of the FX headwinds more broadly. That is better than we saw with perhaps the Microsofts of this world. Alphabet both saw growth slow down compared to where the market had wanted it. Overall, net sales coming in 10% higher where we'd wanted to see with North America, 10% higher on $115. But overall, we want to really see about what the capital expenditure means. The holiday shopping season, so says Andy Jassy, is the most successful yet for Amazon. Remember, if they're managing to be bringing in substantial amount of net sales that are meeting expectations, that means their net sales were bigger than that of Walmart for the first time here in the United States. We're also talking about appreciating the support of our customers, selling partners, interesting selling partners. Some of them are Chinese. We'll see what that means in terms of the de minimis issues, how it affects their business. But overall, we want to hear what they're doing in terms of Bedrock. He says, overall, they're saying AWS introduced the new Trainium 2 AI chip. Remember, they make their own chips, and this is why the supply side was able to meet up with some of the demand side. Our own foundation models, that's Amazon Nova, a plethora of new models and features on Amazon Bedrock because they supply everyone else's models, including that of DeepSeek, I might add. And they gave customers flexibility and cost savings. He is talking up the benefits of being within Amazon when it comes to AI.
Yeah, but it all comes down to that forecast, as you noted right away. The stock is lower by about 5% in after-hours trading after the first quarter sales forecast, missing analyst estimates. And Caroline, here there's a comment about how the forecast includes the impact of $2.1 billion from Forex rates. This is a sign that the strong dollar is hurting not just some of those consumer packaged goods companies, but a company like Amazon.
Yeah, and of course they're going to have big exposure. Of course, the US is still the dominant house in terms of their overall net sales, but in the UK, absolutely focus on all things Amazon. And of course, if you're going to see US headwinds, and that's going to be an issue for a strong dollar. And you have heard that borne out by some of the other key tech names as well over the course of the operating system, that the fact that we've got to have earnings coming out thick and fast, and most of them have been saying, look, FX is going to be a headwind. I want to really dial into whether the forecast is also dialing back some of the AWS demand. That is where we want to hear some of the intricacies as to whether that might be an issue of weakness going forward. It doesn't look like they're trying to signal that,
Caroline, that's what I was curious. Like top of mind, as Andy Jassy and the team get on the call with analysts and investors, what should be top of mind? What should they be questioned most about based on these initial numbers?
Yeah, I think it's all about how much AWS will remain the port of call for corporates who want to have a whole range of foundational models and indeed access to chips and compute. How much is the resiliency? How much are they going to be spending? I haven't yet seen a CapEx number come out.
No, it's not.
And remember, we're meant to be spending about $76 billion for fiscal 2024, and then they might up it all the way to about $86 billion for fiscal 2025. That is bigger than anyone else out there. That's going to drive about $200 billion in CapEx spend for all of those hyperscalers in the United States for the year of 2025. So we want to understand how much they're still committing, because they've talked up about the range of offerings they have at AWS. despite DeepSeek, for them, DeepSeek didn't seem to be a negative. It was only a positive. Come to us, and you can have a whole range of price points and the right model that fits your current needs, whether it's pace that you need or whether it is a reasoning. And that, of course, takes a little bit longer to get the answers that you want out of a certain large language model.
Caroline, I'm looking at first quarter operating income, the guidance for that, 14 billion to 18 billion. The estimate was for 18.24 billion. So that obviously very light compared to estimates. Where's this money going? Is this money being reinvested back into the company? Are they spending it on AWS? Is the shipping costing more than they thought it would? Why the operating income coming in so light?
I mean, it's interesting because the operating margin is still looking very good, and that's 11.3%, and the estimate had been for 10%. So they're still managing to do more in terms of dialing down costs. And the operating income for the fiscal fourth quarter, 21 billion versus 18 billion. So for the previous year, that focusing on bloat, that taking out of costs from middle management layer, the being able to do more with less, has been really a focal point for Andy Jassy. So I think that's notable that going forward into the first quarter, they are going to have an issue. They're also talking up about the impact of a leap year, and that being added $1.5 billion in terms of net sales for their first quarter 2024. And so that's going to mean that it's a difficult comparison for their fiscal 2025. But they are probably going to be giving us a capital expenditure outlay that maybe speaks to why operating profit isn't just being handed back to investors.
And just to also add on this before we move on, Amazon Web Services net sales estimate actually fell below that estimate, 28.79 billion. It was just a little light. And then you bring into the fact that their net sales excluding FX estimate came in line with expectations at 19%. There was not that upside in addition to that. All right, Scar, what you got?
Yeah, that idea that every company has to not just match but beat the numbers that they've been given. All right, let's just move on quickly here to Expedia, because Expedia, the online travel company, also did report earnings. Revenue beat, adjusted EBITDA beat analyst estimates, EPS beat as well. And the company restored its dividend as well, 40 cents a share starting in May after suspending that dividend back in April of 2020 at the height of the pandemic.
All right, real quick, Take-Two Interactive also out with their numbers. Not seeing too much movement in the aftermarket. Let's go right to the outlook. Take-Two sees fourth quarter net bookings of 1.48 billion to 1.58 billion. The estimate on the street is 1.54 billion, and it still sees fiscal year net bookings 5.55 billion to 5.65 billion. The estimate, so there's a little bit of a range there, 5.63 billion, and it looks like on the third quarter net bookings, they were pretty much in line, a little bit light, $1.37 billion. But right now you see that stock up about 1% in the aftermarket.
Hey, one stock that's up quite a bit in the aftermarket is Pinterest, higher by about 22%. The company's first quarter revenue has beat forecasts. The company sees first quarter revenue $837 million to $852 million, beating estimates of $835 million. Fourth quarter revenue also came in a touch above estimates.
I just want to point out Elf Beauty here. That stock also tanking right now. It cuts its annual outlook on earnings as well as sales. They also are saying that they're seeing softer trends in January, so that outlook not doing well. Even though they did wind up beating on revenue, their earnings were a miss, but that outlook really hurting that company right now.
All right, and Skechers USA, the sneaker company, reporting first quarter, or I should say the outlook for the first quarter sales will be lighter than anticipated. At most $2.43 billion. Analysts were looking for $2.48 billion. And it sees first quarter EPS at $1.10 to $1.15. Analysts were looking for above $1.56, so a lighter than anticipated outlook from Skechers.
All right, quick update on Amazon, which has been down as much as 7% in the aftermarket after that first quarter sales forecast missing. Right now the stock down about 3.7%. So paring back some of that decline, but that earnings call with the Amazon C-suite and certainly analysts and investors, that'll be really important. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. We'll see you again, same time, same place tomorrow.
All right, we are looking at shares of Amazon declining in the after-hours trading following its latest results, tumbling, in fact, on that first quarter sales forecast coming in a little bit lighter than what was anticipated. Caroline Hyde, co-host of Bloomberg Technology, is with us here. How much of this can we blame on Amazon Web Services, which is obviously the most profitable part of its various businesses?
That's what we've got to strip out, and that's what you're going to be tuning in at 5 p.m. New York time for the web conference overall, is to see what is feeding into the forecast here. They're blaming writ large on the sales, the Forex issue here and the foreign exchange that's going to be $2 billion or 150 basis points. They're also talking about a leap year, so that's obviously going to hit the e-commerce side of the business when you're looking at comps. But they were strong in AWS for this fiscal quarter that they're reporting on prior. So the fourth quarter was not looking bad. It had, I think you said the nuance, Alex, that perhaps they came in just ever so slightly, sort of point something billion off. But ultimately, they're talking up the expansionary focus of AWS. They're talking about net sales were expected to come in at 19%, and it came in at 19%. They're talking about the desire to have the offering of the AWS Bedrock that gives you a whole raft of large language models that you could be adopting and foundational models you want to purpose within your business. And we want to know about what the breakdown is of big corporates versus startups as well. This is a question of keeping market share. This is a company that is the #1 cloud provider, and we've got Google doing pretty well, Microsoft trying to make inroads. They were dialed back a little bit from their supply side, Oracle trying to plow in.
But then to that point, I mean, AWS has 40% of that market share, right? 19% growth, but Microsoft's growth, even dialed back, is still like 30%. And I wonder if that therein lies the rub.
Yeah, the AWS has been at this an awful lot longer, and maybe some of their overall 19% growth rate is going to be baking in some years that they've been at this offering of data centers and compute more largely, and that they've got more data centers there and available. There had been this ongoing issue, of course, of access to NVIDIA chips. And I think this is why you've seen Alphabet getting in on its own chip making. And certainly we've seen time and time again, Matt Garman, who's AWS CEO, talking up the fact that they've got Trainium, they've got their own chips. They've been designing them to be able to be an addition to NVIDIA. They don't want to be losing the access to GPUs, but they want to be having it as well, so they're not lacking in that supply side. But they have got to be expanding, and I'm really interested as to what that capital expenditure number is going to be.
Yeah, we are all into that. You will tell us at 5 o'clock.
I guess tens of billions of dollars. That's what it's been.
Maybe, probably more than 74 billion, since that was what it was this year. All right, Caroline, thanks a lot. Caroline Hyde, co-host of Bloomberg Technology. So we're looking at Amazon stock now down by about 3.5%. Net sales and operating income for the first quarter, their forecast coming in a little bit light. Want to get more on this with Rohit Kulkarni. He joins us, a senior analyst of internet and capital markets at Roth Capital Partners. Hey, Rohit, what's your take on these numbers?
It's a small miss and a small kind of lowering of guidance. As in, I think expectations were high going into the print. Stock was up almost 30% over the last 90 days. So when some stock moves like that, you set a very high bar. FX was a known issue. Some of the unknowns were around what 1Q guide would look like. I think that is one thing that we'll probably probe into on the conference call and look into the numbers more closely as to 1Q guide, even with FX, is slightly less than what we would have expected. The silver lining here is margins, I think. In 4Q, margins were really good. North America retail margins at 8%. AWS margins up almost 37%. These are record highs. So I think the company is hitting all cylinders on profitability, but revenue growth for 1Q is something that, are there tariffs? Are there some other external factors apart from FX is something that we'd like to look into.
To what extent do you think Amazon is being super conservative in offering this guidance, mainly because there's so many question marks when it comes to tariffs on China in particular and how things are going to shake out?
I think if that's the case, then probably this is an overreaction to the downside. If management team clarifies that, hey, look, we are sitting at this juncture where there are several pathways that how things could unfold over the next 60, 90 days, and we are taking a slightly more conservative outlook in along that pathway, then perhaps this is something that we would aggressively be buyers of on this weakness. But we don't know that yet. So that's something that we'll probe into. And I heard you guys talk about CapEx. I think CapEx was a very high watermark number, more than $27 billion in Q4. So we know that run rate translates to a $100 billion number for 2025. Again, that remains to be seen how high Amazon can go on CapEx.
Okay, I was going to ask. So on the call, when we get clarity for CapEx for 2025, like what's a good quote unquote number if you're an equity investor, if that makes sense?
In my opinion, anything less than 20-25% growth versus what they just did in 2024 would be considered as benign. Anything more than that, approaching $100 billion or more, would be eye-popping, and then that would start to raise more questions around when do you get returns, in what form do you get returns, and how patient do investors need to be.
Is Amazon a winner or a loser from the advent of a cheaper AI model from DeepSeek and other companies are able to do something similar?
In my opinion, Amazon was somewhat of a lazy loser. I would call it that way. As in, think about it. Over the last 12 to 18 months, Amazon, to a large degree, did not invest a lot in creating their own foundation models. Only in late December is when they actually started to launch their own models at the same rate that we have seen other companies like Facebook, like Google, and OpenAI launch over the last 2 years. So to some extent, having a second mover's advantage is what probably Amazon has, and the fact that they now have DeepSeek probably integrated in AWS and be able to build apps on it. I think Amazon is a net winner as a result of what's happening with DeepSeek.
All right, that stock down almost 4% continually here in after hours. Okay, what would be your question on the call, Rohit? Give us a preview.
How high can you go on CapEx, and what is the earliest indicator of return on that high CapEx over the next 3 years, and how does that manifest?
All right, we still have earnings coming out. Thanks a lot, Rohit. We appreciate it. Rohit Kulkarni, Senior Analyst in Internet and Capital Markets at Roth Capital Partners. Thanks a lot. All right, let's go to Affirm here. That stock up in post-market trading. It's really their outlook. They raised their outlook here, looking at third quarter revenue at the high end, coming at $785 million. That beat, as well as looking at their gross merchandise volume at the high end, about $8.3 billion. That is also a beat. Remember, this is a buy now, pay later firm, so really good read through on those consumers, taking a look for their third quarter. Also, when it comes to the second quarter, they did actually beat on their major lines.
All right, let's move to a software company, enterprise software company, Cloudflare, coming out with results. Fourth quarter numbers beat analyst estimates, but it's the outlook that's a little bit light here. First quarter revenue will be at most $469 million when analysts are wanting to see $475. As well, first quarter adjusted EPS will be about 16 cents, 2 cents shy of the consensus estimate. You can see, though, the stock bouncing around here is slightly higher in after-hours trade.
Okay, so what did we miss? We got Pinterest, that's up. We got Amazon,
Expedia down.
Expedia down, right? Okay, I think we got everything.
All right.
That's a lot. That was different sectors and a lot.
But we're going to come back to Amazon later on because we want to talk about freight. We want to talk about streaming. And this is a company that's all things to all people. So coming up, we're going to speak with the CEO of XPO to discuss their latest earnings results and the outlook on the freight transportation industry, given all of the tariff threats on U.S. trading partners from the U.S. That's next. And this is The Close. All right, shares of XPO closed the day higher, gaining more than 7% after their fourth quarter profit beat analyst estimates. XPO is one of the largest LTL, that is less than truckload freight providers, with coverage that spans the U.S., Canada, and Mexico. Joining us now to discuss all of this and more is Harik, CEO of XPO. So we'll get to the fact that you are present across North America and tariff threats in a little bit, but I want to ask you about your earnings first. Fourth quarter net profit was higher despite lower revenue, and you anticipate a pickup in North American freight activity. What's driving that?
Well, overall, if you look at our results, we had an excellent quarter in the fourth quarter, but we also had an excellent year. So despite being in the trough of the freight market, where we have seen overall industrial demand being down in North America, we were able to deliver great outcomes for the customers. And that goes back to strategy is working. We have great people behind that strategy executing it.
So you feel like it's idiosyncratic to you guys rather than a broader market or your offerings?
Yeah, it is idiosyncratic from the perspective. If you look at 2024, we were able to grow earnings more than 30%, and we were able to improve our margins 260 basis points. And we were the only carrier in North America to be able to deliver these kind of results.
So now I got to ask you, how are you thinking about the imposition of tariffs on Canada and Mexico? 25%, which was originally supposed to start in early February, has been pushed off at least until early March. But, you know, it's a big question mark as to when it happens or if it happens.
Well, first tariff, it's still a bit early to tell what the impact's going to be. I mean, there's still a lot of uncertainty of how they will unfold over the quarters and year to come. But from our perspective, we want to support our customers. So if our customer's supply chain is moving or they're sourcing the product differently, we have been investing in the domestic trucking environment. We've added more than 25 new terminals here in the U.S. over the last year. And these will help us to have the capacity to provide the service for our customers. So that's goal number one. Goal number two is, when you look at the less than truckload industry, we believe that tariffs will be more constructive for us, because when a manufacturing plant moves to the U.S., when companies nearshore manufacturing, you have more demand on domestic trucking, and we would be beneficiaries of that if that does happen.
Okay, two what ifs to that. One, what if we get 25% tariffs and demand gets hit, or prices just increase for goods? How do you expect that to pan out?
So overall, higher inflation usually does lead to lower economic demand if rates stay up higher. But we will see how that will unfold through the course of the year. Obviously, we're not immune to a lower demand environment, but at the same time, our goal is to provide a great service for the customer and gain market share over time, which is what we've done in 2024.
So it sounds like net, tariffs could be a positive for a company like XPO. That being the case, the other part of President Trump's agenda, of course, is crackdown on immigration. And I know that during the pandemic, it was hard to hire people. The crackdown on immigration threatens to tighten the labor market. What does that mean for a company like XPO?
Well, I'll tell you, for us, that we have a company-specific program that I'm very excited about, which is we run our own driver schools. So we have more than 120 locations across the U.S. and Canada, where we can graduate drivers to earn their CDL. We pay for all of their wages as they go through the school program. And then once they graduate, they join our rank as a professional truck driver. And they usually stay with us for a long, long time. Half of our drivers have been with us for more than 10 years. So when you think of that program, we can graduate up to 2,000 drivers per year to join our ranks as well.
So let's go to margins. Is the 150 basis point in margin improvement that you're expected for next year, is that the base? Is that light? Is that conservative, maybe?
Well, when you look at our margin outlook, it doesn't include any impact in terms of improvement in the underlying macro or demand environment. So our expectation,
or any weakness on the flip side.
Or any weakness on the flip side as well. But a lot of that is driven by our strategy, where from one perspective, our service product has never been better for the customer. So the customers are giving us a bigger share of wallet, and they eventually vote with their wallet where they can move the freight, who they move the freight with. And the second component of that, we've been managing costs very effectively. Our technology is all proprietary, and our folks in the field are executing flawlessly in terms of labor productivity as we go along, to be able to, whatever the volume environment does, to be able to flex the cost structure to meet that as well. So if there is a macro pickup through the course of the year, we would see that as being upside to our outlook.
Separate from what the Trump administration does on trade policy, what's your read on the economy right now? What are you seeing from companies and their needs? And longer term, how sustainable is this economic expansion that we're in?
Well, when you look at the industrial economy, and today 2/3 of our customers are industrial companies, and we are predominantly a North American company, so US-based, where we have the lion's share of our business. And we survey our customers before every time we report earnings, once a quarter, and we have seen much more optimism from customers here in the last survey. Just to give you an example, there was a 10-point pickup in folks expecting an acceleration of demand in 2025. And about half our customers that we surveyed are expecting for things to accelerate even here in the first half of the year. So we are hearing much more optimism from the customers, especially in the industrial sector, for a recovery. We haven't seen it yet in the demand environment, but we are hearing more optimism.
They're signaling it.
Yeah.
So I wonder then that easily compares to the ISM manufacturing data that finally got above expansion level and above 50. Do you feel like that's then sustainable and that there's actually a trajectory higher? So we've had some fake outs.
So yeah, we did have a few. I think we had one in March of last year, but it's been predominantly less than that 50 mark. Now we have the two important signs there. One is that the ISM went over 50 in January, but then new orders in the ISM was at 55, and that's a good leading indicator. Now usually for transportation, the ISM lags or leads the demand in the transportation sector by a few months. So we'll see over the next few months how things shape up.
What's the single biggest risk in the next 6 to 12 months from where you sit?
I mean, high-level macro could be a risk. What happens with the demand environment and whether that we would see the pickup we are anticipating or not. But otherwise, we have a great plan, we have a great team behind it, and we're looking forward to execute another stellar year in 2025.
All right, Mario, happy guy. Good earnings. Looking forward to this year. All right, Mario Harik, CEO of XPO, thank you very much. We really appreciate it. Let's get a check here on Amazon. That a company missing in its operating income for this next quarter, as well as first quarter sales will be as much as $155.5 billion. That comes in light of estimates. The stock, though, Scarlett, off the lows of the session here in post-market, just now off by about 2.6% as we head to the call at 5.
And it's all about what the company says when it comes to to CapEx, right? I mean, we know that Meta has committed to $65 billion, Microsoft about $80 billion, and Alphabet somewhere in the middle. We need to know what Amazon is projecting in terms of its spending, because AWS, it did achieve 19% growth, which is pretty much what analysts expected, but that's not good enough this day anymore.
That was just what analysts expected, so you're totally right. And I did point out that net sales estimates coming in a bit light. Now you tell me, 28.82 versus 28.79. I realize I'm splitting hairs on that, but
that's
the
what analysts do.
expectations are really high, so you got to then get a payoff for that as well. And didn't Amazon say that they were going to be spending more on CapEx this year than last year, and last year's run rate was really high already?
So we'll see what the number actually is and whether they've adjusted that at all in the wake of DeepSeek. I don't think any of them have they?
No, because it came out too quickly. And also, they all knew about DeepSeek. We were the ones who didn't know about DeepSeek.
Yeah. That's true. They might have been surprised by the reaction in the market to DeepSeek.
Maybe, and then have to justify that higher spending as well. All right, coming up, we're going to check on Amazon's ever-expanding streaming business. Remember, they do that as well. With Seema Shah of Sensor Tower, she's going to give us the data. Also check on ad sales as well for the streaming space.
Yeah, they have commercials, so I don't watch Amazon Prime anymore.
Well, we do, and watch the commercials. My daughter likes them now.
Really?
Yeah.
You converted her.
This is The Close on Bloomberg.
We have been hit with a tide of earnings, so let's get you a roundup of some of the big movers and bring in Bloomberg's Bailey Lipschultz, Jess Benton, and Emily Grafeo. Bailey, let's start with you. You're keeping an eye on Pinterest.
Yeah, Scarlett, a big jump after hours. You can see up more than 16%. Pinterest beating on pretty much every metric in the critical fourth quarter. We're talking about revenue, EBITDA, average revenue per user beating expectation, a record number, of users on the platform in the fourth quarter, crushing analyst estimates, and also looking forward to that first quarter guidance, beating on both the top and bottom line. The company really talking about how their kind of revitalization as a shoppable platform, those partnerships with the likes of Amazon and Google actually helping benefit both the top and bottom line for this company. Again, critical fourth quarter for shoppers, kind of getting back to where the stock was a year ago. So still, if you bought this back in 2021, you're down about 50%. But if you bought it in the last few weeks, we're seeing the stock continue to grind higher after closing at a 3-month high. Jess, you've got a stock, though, that also is higher.
So we're looking at video game makers, in particular, it's Take-Two Interactive. So actually, you see the stock reverse up higher now after the bell, after initial move lower. Initially, when you were looking at what was happening with the net bookings for the final 3 months of last year and the current quarter, came in below expectations, but fiscal year that did come in above the consensus when they're thinking about $5.5 billion to $5.65 there. But the big thing everybody wanted to know was Grand Theft Auto 6. When is it going to come out? In the release, they said it is going to be in the fall. The CEO confirmed that. So obviously, on the earnings call, more investors want to hear about it. Of course, when you think about with Zynga and its acquisition within recent years and the slowing growth when it came to mobile and games, they want to hear more about how that turns around. But still, its stock is off from its all-time high from about 4 years ago, more than 10% down. So investors are going to want to hear more about their plans for mobile growth. But I know Emily's looking at travel stocks.
Yeah, I have a pretty good gauge of the consumer. Expedia here. This is the online travel booking agency. The stock is up almost 9% right now after posting better than expected gross bookings for the holiday season, really reflecting that strength of the consumer. Expedia gets about 2/3 of their revenue from the U.S., so it specifically is reflecting that strength, at least in the U.S. consumer. They also beat on fourth quarter revenue, and they beat on fourth quarter EPS, that revenue coming in at $3.18 billion. And this overall kind of rosy picture of travel and consumer is also reflected in earnings reports that we've seen from airlines over the past few days. Delta and United both beat. Now for Expedia, the call is at 4:30. We're going to be looking for that outlook for Expedia because they haven't announced it yet.
All right, thanks a lot, guys. Really appreciate it. Emily, Jess, and Bailey, really appreciate that as well. We also have results from Affirm and Cloudflare. So Cloudflare matched their estimates. They did point out that they're adding some of those largest customers, though. So the more customers that spend more, they added some of that. Also, Affirm, Scarlett, quite interesting. Revenue forecast for the year beat. Every quarter, we're looking at a potential beat. Gross merchandise volume, also a beat. Affirm really firing here on all cylinders.
I mean, if you look at these two companies, Affirm especially, it would seem that the consumer is pretty healthy at this point. This is a buy now, pay later company, and it relies on people continuing to spend. And if they don't have the means right at the moment, maybe they'll take out not a loan, but they'll use the service.
Okay, but this is my question. When does a buy now, pay later become a negative read for the economy because you don't have that liquidity, the liquidity that you normally do? And I don't know if we can make that comparison, right? It's like with banks. It's like, when do we look at the charge-offs in a good way versus a bad way? What is that tipping point? But I was reading through the release, and apparently they have a deal with GoodRx, and you can do buy now, pay later with meds. And that, I think, is quite interesting.
Well, I mean, it's one thing when you use buy now, pay later for discretionary items. It's another thing when you use buy now, pay later for necessities like your medications, the daily medications.
Yes.
You're running a balance continuously.
Yes, absolutely. So looking at both of those stocks right now. But of course, we got to get back to Amazon. And that latest report, CEO Andy Jassy continues to stress focusing on 3 pillars of growth: e-commerce, cloud computing, and advertising. Like many other streaming services, it's adding commercials to its Amazon Prime Video segment. Joining us now for her outlook on streaming for Amazon and others is Seema Shah, Vice President of Insights at Sensor Tower. Seema, I was telling Scar that my daughter runs out of her room now when she hears all the Allstate or all the insurance jingles. She knows them all because of Amazon Prime. What does the streaming ad landscape look like?
It's actually been very interesting. Just to take one step back, when we look at streaming, we actually compare it also to social media and to short form video, right? Because they're all competing for users' time. So at a high level, what we're seeing is a pullback in users' time spent across these 3 segments, streaming included. So we think there could be a little bit of app fatigue if you think about it, right? So as a streaming company, I think that's why you're seeing more people add ads to their platform so they could further monetize that, right? And so what it really comes down to is the tentpole content. Do you have a key show? Does it bring in the viewers? And if it's not a key show, what you're seeing now is everyone moving to live sports. And that's really where they're trying to get the subscriber numbers. And in terms of advertising, we've seen Netflix do it. They continue to grow their advertising base. They're getting new advertisers every quarter. And I think Amazon doing the same thing. It's a great way to monetize your platform. Now, for these other streamers, they are charging different prices for their ad-supported subscriptions. So Amazon Prime comes with your Amazon Prime Video. You get it part of your subscription. So I don't know how they'll pull that out. But I think at the end of the day, it's just a great way to also reach a broader consumer, but it is a competitive space because engagement across sort of this entertainment space, I think is pressured, at least in our view.
What's interesting about Amazon is the strategy it took when it came to streaming and commercials, right? Because they basically moved everyone who was in Prime to the commercial tier. And they said if you want to opt out of it, then you have to pay a higher price. Whereas Netflix did the opposite. They basically made it cheaper for you to go into the ad tier. Did that give Amazon an advantage with advertisers?
I think it might have, because you think however many million, 150 million, however many Prime members there are, you essentially have now this audience, right? You don't have to even work for this audience. You already have the number of viewers that they have. And then if the commercials bother you, obviously you can pay more to get it without ads. So I think from an advertiser perspective, it is attractive. But then if we look at the broader landscape of streaming, I think there is competition for Amazon to attract, advertisers, right? Netflix has the highest retention rate of all the streamers that we cover, right? About 70%. The way to continue to grow, you saw Amazon highlighted their Thursday Night Football, how that was growing, and sports is becoming an increasing part of getting that engagement. So it's not just having all the viewers, you have to keep them engaged, and then that goes right back to content. So I think it's great that they started out with such a huge base, but I don't think that's enough just to keep going.
So what kind of ad pricing does sports on streaming get right now versus, say, linear?
Well, they pay a lot for the sports content. And I think each league and each type of sports event has a different pricing. And that's what's negotiated by all these networks. But it is essentially where we're seeing the biggest boost in MAU growth, right? So for Netflix, for example, during the Jake Paul, Mike Tyson fight, we saw a bump up. They had the football game at Christmas. Paramount has been doing well this past month because of the NFL game. So we continue to see that it's the sports. Sports is sort of very fragmented, right? The rights to sports are fragmented. So everybody has a little piece of it, but those are the events that are driving I think, the biggest user engagement. I think that's why we also saw Disney originally purchasing Fubo, and they were going to have that partnership, which they decided not to have. But we know that Fubo had, a strong run of MAU growth also related to sports. So it's just something to keep in mind that sport content, it is very pricey, but it is what moves the needle.
And it's what some people are willing to pay as well. I'm glad you bring up Fubo and Disney because a lot of people are anticipating consolidation in the streaming sector, the strong buying some of the weak players. Where does Amazon fit into that? Because streaming is part of Amazon's business, but it's certainly not the biggest part of Prime.
No, it's not the biggest part of Prime. I mean, I don't see any of these other players buying Amazon Prime Media, but I think what you might see, I think you do see consolidation across the space, right? Because it's a pretty saturated market, as I said. We are seeing app fatigue. So really the best way to continue to grow is you either have to have the content, and how are you going to get more subscribers? It is by picking up these smaller streamers that have different content that maybe attract a different audience or a different region, a geo. And you see that like with Disney pulling in Hulu. Hulu is right now what we see on our OTT ad data is the largest ad supported OTT platform. So it's still the biggest, even though Netflix and everyone are coming in. And for Disney to add advertising on its Disney Plus, right now they have Hulu. So there's also a lot of back end work that needs to be done so that it's attractive for advertisers, right? What information are you giving back to them so that they know this is a good investment? And I think Disney with Hulu has that advantage because they've already been doing that. And for Amazon, I think we'd be more likely that they might pick up smaller streamers if they just want to broaden their content and broaden, because for them, then they can cross-sell maybe to Prime. Right. If you do a Peacock, whatever streamer, maybe you can cross-sell their many other services that they provide.
All right, Seema, really appreciate your joining us. Seema Shah, Vice President of Insights at Sensor Tower. Just a couple of other earnings we want to get you up to date on. Skechers, the sneaker maker, dropping as annual sales and profit forecasts disappoint investors. And I left Elf Beauty for you because invest in your face.
Right, but that's not going very well. I mean, I feel like you look at L'Oreal, didn't go very well. Estee Lauder is looking at a different.
But you're still doing it. You're still investing in your face.
I definitely invest in my face, but clearly not with Elf Beauty. They're cutting their annual outlook all across the board on earnings as well as revenue, and that would hurt. Even though their third quarter revenue was a beat, they did miss on earnings, and that stock is then really struggling. I wonder if we only invested in our face during the pandemic, and now no one cares about their face.
They said further slowing appears likely in 2026 as demand for beauty remains soft.
Crazy. I wonder what kind of beauty. I don't know. Hey, if my things could go down in price, I'd be super pumped. But that never, ever, ever, ever happens.
Deflation? No, that doesn't happen. This is the close. You. Bloomberg. All right, we are, of course, keeping an eye on shares of Amazon, one of the last Mag 7 names to report. It is down in after-hours trading about 2%, so it's paired some of its losses. Net sales for the first quarter falling a bit shy of analyst estimates. They also gave a weak outlook because of a rise in spending for what else? AI. Our next guest, though, is undeterred. He has an outperform rating on Amazon and just increased his price target on Amazon to $280. Who else but Dan Ives is joining us now. Dan is Managing Director and Global Head of Technology Research at Wedbush Securities. You are not concerned with this slightly weaker forecast.
I think if you looked up sandbag special in the dictionary, you'd see Amazon's ticker. Because look, the actual quarter beat on AWS, strength on advertising. And I think on the retail side, they have massive momentum into 2025. I think, look, now, just even take a step back from Mag 7, these CapEx and all these numbers, I think you even feel more bullish about the AI revolution when we talk about the AI
better entry point?
just because of what's happened in terms of CapEx. I mean, go back to DeepSeek even, a week and a half ago. Now look at these numbers. I mean, they're doubling down in terms of spending. And I think it continues to really be now the second, third stages of this AI revolution playing out.
If we want to go, I want to go to AWS for a second, though, because if you back out FX, they grew at 19%. That just hit estimates. They missed on revenue on that estimate by a hair. Isn't that the problem? That expectations are so high that if you actually just meet it, it's not good enough because you have, Microsoft growing at 30% when it comes to their cloud business.
Well, I think 24 hours, and this is a stock that's green. I mean, I'd be shocked if it's not.
Well,
up
already
tomorrow.
it was down 7% and now it's up by 2%.
But it goes back to these prints come out, the bears come out of hibernation mode, try to paint some negative narrative. But the reality is that, to your point, like AWS, I actually think Jazzy and the team are actually on offensive mode. I think actually continuing to gain share. Look, Google clearly had a little softer on the cloud side. Microsoft was more of a capacity issue. But I think what this really shows is more and more companies are heading down this path because of AI. We are in a fourth industrial revolution. And you're starting to now see, of course, Messi of AI, Palantir, and others, you're seeing it spread to the rest of tech.
You called it a sandbag special. I mean, all the guidance that we got from the other Mag 7 names, NVIDIA, of course, has yet to report in about 3 weeks. How low did they set the bar for themselves because of all the uncertainty that's out there?
Look, I think if you're Jensen, the godfather, of AI, listen to these conference calls. I mean, they're sitting there. He's sitting there with his crocodile leather jacket.
It's crocodile leather.
Crocodile leather. I mean, look, but it could be wearing the regular black leather jacket. Okay. But, I mean, sitting there probably, feeling very good about these earnings because it's very similar to what we see with our checks. Demand to supply is 15 to 1. And there's only one red phone that you could call for that chip. Mm-hmm. It's NVIDIA. And it just goes back to DeepSeek and all the worries. We basically have $2 trillion of AI CapEx in the next 3 years, where this is really a company, and of course AMD and others will eventually join, but it's an NVIDIA-led market, and that's why I continue to think this sell-off that we saw in NVIDIA, it's a table pounder.
So when you take a look at earnings estimates, say for the Mag 7, they're still growing 18%, but they are coming down from their peak. And do you feel like that is reflected in valuations right now, the slowing growth?
But I view it more as just a digestion period before. So
it doesn't keep slowing. It's just like it's going to come back. It's like
exactly.
a U-shape.
It's a U-shape. Mm-hmm. It's a great point because a lot of it is really capacity. These build. If you think about all this CapEx, call it $400 or $500 billion of tech CapEx, even in 2025, where that spending is going to come through. It's 26, it's 27. You look at even when you think about robotics, autonomous, enterprise use cases. When we think it's going to be about 10% of IT budgets in terms of AI, look, you go into this weekend, despite all the noise, you feel much more even bullish about tech, after this earnings season.
If you're China's DeepSeek and you're looking at these results, what's your takeaway?
I think your takeaway is, look, I mean, they have a very strong model. Open source continue to gain massive traction. But anyone that believed the fictional Netflix story, that DeepSeek in terms of, 6 million and, in terms of this is really going to take down the overall AI infrastructure, this earnings season goes totally against that. I think what DeepSeek showed, great models, that's going to become more and more of a commoditization, but it's an arms race. But that's the DeepSeeks, whether it's China or US or wherever they are, that's bullish for overall AI spend because of the GPU spend. So I never viewed it as a negative. Right. I just view it as competition, which I view as a positive.
Which makes sense given how much money was in this sector overall.
Yeah.
But I do wonder if it, though, broadens the AI plays, like software, maybe not over NVIDIA, but own the software guys because maybe this is going to become cheaper for them to adopt, for example.
And that's why the Messi of AI, Palantir, I mean, that's really the one, Carp in that Mount Rushmore, because they're the first ones seeing it. So look at those numbers in terms of Palantir. Now,
untamed organic growth, right?
It's untamed organic growth, but if you look at it, is that they're continuing to play chess, and others are playing checkers at the kids' table. Now what's starting to happen is you look at other software names, Snowflake, Mongo, I think you'll see with Oracle and others, and of course, Condon at the FTC, you're going to see a lot more M&A in software, and I think this is just overall very, very positive for tech sector as that spreads.
Which companies in the tech sector lose out right now?
Yeah, I think when you think about ones that are losing out, you got to look at maybe a name like Cisco in terms of some of the hardware plays. I think that's one.
The networking gear maker.
Networking gear maker. You could have said year and a half, 2 years ago, IBM. Now IBM is a gainer because everything Arvind and the team have done there. So I think it's one, these are going to be kind of fork in the road situations, but software will continue to dominate. Hardware will ultimately, give up share. But that's why these tech companies, it is an arms race. You have to spend. If Street ultimately worries about that, I think those are just near-term issues.
Okay, so to that point, what is the CapEx number we could hear on the call that would freak investors out, that would make you buy the stock?
I mean, to me, there's no cap. I mean, I think CapEx could ultimately be up. I mean, if you think about 15, 20% above the Street. But if you look at what you want to see them do that, because Jassy and the team, ultimately from a CapEx perspective, if they had a lighter CapEx, what does that show? That shows everyone else is going to be spending massive amounts and they're not.
So the CapEx shows conviction.
It shows conviction, it shows determination, it shows AI, because the last thing you want in this AI party, it's 10 p.m., it was 9 p.m., you don't want them behind the velvet ropes being like, hey, let us in with Palantir, Carp, Jensen, everyone else. You want them in that AI party on the dance floor.
All right, but we are at 10 p.m. now. It's no longer 9.
But it goes to 4 a.m.
Yeah, I'm just saying.
Of course.
Some time has passed.
The clock has been moving.
It has.
Dan, always a pleasure. It's really good to catch up. Thanks
you.
so much, Dan Ives, Managing Director and Global Head of Technology Research at Wedbush Securities. Scar, pretty much no one you want to hear from first when it comes to Amazon.
Absolutely. 10 p.m. now. Like, does the clock ever move backwards? Could it? If you took a gummy, could the clock move backwards?
What? Wait, so we wouldn't take a gummy.
I made Dan laugh.
So the clock moves backwards.
Yeah.
Is that like better for the
It goes to like 9:30 p.m. or something.
Where do the gummies come involved?
And then maybe even 8:39, which is.
You got. Oh wow! You just blew his mind.
You blew my mind. And after think about that.
Okay, great.
What could move the clock back? I think is a different story.
All right, still ahead. We've got what investors need to watch for over the next 24 hours. This is Bloomberg. All right, it is Thursday, Jobs Day Eve, so let's look ahead at what else is coming up over the next 24 hours. I think I just gave it away.
You just did. Jobs Day.
Okay. 8:30 a.m. payrolls report, but there's also revisions involved here, so there might be some room for drama.
Yeah, but look at the options market. Piper Sandler was saying the options market is pricing a 0.9% move in the S&P to the up or to the downside, which is pretty much in line to the last 12 months. So nothing in terms of the market action seems pretty unrealistic.
Okay, and then there's University of Michigan's sentiment, which people pay attention to now because of consumer expectations for inflation.
This is one of my favorite indicators. It's the preliminary read for February, so it's going to encompass everything that we saw in January, and it's going to be interesting to see if it encompassed the beginning of February tariff drama and how that's feeding through. Also very much in the political party sphere, right? But still, I love this read.
Not just tariff drama, but all kinds of drama when it comes to policy, right? All right, then we've got Fed Speak. Fed Speak is back. Bowman and Kugler will be speaking, so of course we'll bring you those headlines as they cross.
And it seems like everyone's sort of saying, let's just hold on, let's wait. We have to take into account tariffs. We don't know what they are, so we're all waiting. It seems like they're all coalescing around that point, equally concerned on inflation.
At this point, no one's cutting rates anytime soon. It probably won't happen until at the earliest the second half of the year. Also, by the way, tomorrow we've got a Super Bowl edition, a special edition of The Close in the 4 p.m. hour. We're going to speak with a whole group of people. The president of the Kansas City Chiefs, Mark Donovan, the Patriots chairman and CEO, Robert Kraft, the CEO of FanDuel, Amy Howe, among others.
Way to sell it. Way to sell that.
I'm really excited.
I won't be here for that. I know it's a surprise to everybody. That does it for us.
What will convert you?
Balance of Power is up next.